Hi everyone, it's Tom from the Calder Group here again. We've just gone into December. We've just come out of lockdown to go into lockdown, or lockdown Mark 2 or Mark 3 or whatever it is. We're still in lockdown. But obviously today there's been some news that we'll touch on in a moment. But it's the end of, or coming to an end of another quarter. So time to go through the investment markets and see what hasn't been happening and what we should be looking for going forward. And I'm pleased to welcome again Alex from Blackfinch along for today's meeting. Hi, Alex.
Hi, Tom. How are you doing?
I'm very well. How are you?
Good. Yeah, very well indeed. Very well indeed. So looking forward to hopefully getting out a bit more over the Christmas period. But as you say, we shall see. It depends on what
Absolutely. Yeah. To be honest, I think they've done it very cleverly. Tier 1 is if you're living offshore, so Isle of Man, Isle of Wight, and everyone else is Tier 2, Tier 3. Unless you're in Scotland, when you might find yourself in Tier 42.8, because they seem to have so many of them up there. But I must admit, at the moment, I don't know what the difference is between what we've been doing for the whole of November to what we're supposed to be doing from today's date. But I've no doubt I'll find out when the police arrest me for something.
Yeah, that's right. Yes.
Now, obviously, we've talked quite a bit over the year, so we're going to wrap up 2020 and try and put it behind us and move on. But actually, from an investment point of view, I think it's fair to say it's been actually a really, really positive year, even with that huge dip in market turmoil back in March, if people remember it. What have we actually learned from 2020 when it comes to investments? What can we take forward as lessons other than cross 2020 out of your diary and pretend it never happened?
Yeah, it's been really quite a fascinating year for investment markets. And I'd say really the two key things that have emerged from 2020 really is don't fight the Fed and don't fight the FANGs. So obviously the FANGs being those sort of key basket of tech-driven or tech-enabled companies, which really have boosted a lot of the investment markets this year. And I think certainly with the don't fight the Fed piece, the power that sort of central banks have, and I say the Fed, but I mean sort of central banks globally, the power that they've had, the impact that they've had positively on markets in the wake of the pandemic has really been extremely powerful. And the sharp rebound in asset prices that we saw late spring through the summer really is down to that quick action from central banks across the world. And actually, broadly, they've been praised. And I would say the feedback in terms of response time has been very positive. And that's reflected in capital markets.
Yeah.
I think the other point that we absolutely have learned, and we knew this already, and we've touched on it before, is the importance of diversification. The case for a well-diversified investment portfolio has never been better sort of analysed really and shown through than 2020. So the sharp sell-off we saw in spring was muted, certainly by a well-diversified portfolio. And equally, the rebound out the other side, again, a well-diversified portfolio certainly captured the benefits there. And active managers have really had their chance to shine. So a quality active manager took advantage of the large swings in markets, both up and down, to really generate outperformance for clients, and the quality active managers have truly shone through.
Absolutely. I must admit, I track a number of portfolios, yours included, to see how the performance is going. And actually, we've seen quite a shift this year in terms of those who performed exceptionally well and those who have either dragged their feet or actually, in some cases, returned a negative return over a year when, as you say, there's so much positivity out there, technology, healthcare, even down to government borrowing, which obviously people find a bit strange to say we're borrowing more than ever, yet the capital on that is increased, which I must admit, you sit thinking that doesn't make logical sense, but I suppose that's investments.
Yeah, that's the investment markets for you. But yeah, lots of factors at play there. But indeed, I think it's absolutely vital, for people like yourselves and ourselves when we're running the portfolios to consistently be analysing those active managers. And as I say, it's been clear those ones that have truly been active, so been very proactive, acted on those market swings and positioned their portfolios respectively. And really, as you've alluded to, the others which say they're active but really haven't been sort of active in the investment changes, and you can really see the difference.
Absolutely. And if anyone ever wants to have a look at those differences, we've got the systems that we can take a look and see how your portfolio has worked compared to how others have done, and make a decision on that. I suppose then the question is, that's backwards, and the issue with investments is you can always look back and go, didn't that do well? But that's done, finished, moving on. In 2021, is there any themes? Are there any concerns we should be looking at? I mean, to this morning, we woke to the news that Pfizer is going to be injected into 20 million people, I believe, over the next couple of weeks in the UK. We've still got other vaccines that are coming out. I think the Oxford one is due for approval sometime next week or the week after. So we're getting very close to what they call normality. This year, we've obviously had themes like healthcare, like technology. Are we at the point of actually they're now played out because we've come to the end game, we know what they've achieved? Are there other areas that we should be looking at? Are retail players going to come back? Are there themes that as a manager you're looking at for 2021, and are there areas that you should avoid? We described off air the old adage of this guy I know down the pub, it's now this guy I now follow on Facebook. What are the themes we're looking at for 2021?
Yeah, it's a couple of really good ones. I mean, you make the point there about tech, and obviously it's undeniable that it's had such a strong run, and people quite rightly ask, look, how much further can it go? And of course, I wouldn't expect to see the level of growth in the tech names repeated next year. Whilst we believe that there is still further growth, I mean, I think what this sort of whole lockdown period and COVID life has really emphasized is kind of the embrace of technology, and actually by markets which typically wouldn't have been embracing those technologies or would have been slower to sort of adopt them, and they've almost been forced to. And of course, there's going to be the question is, when normality returns, how much of that how much of those new users will continue to use those technologies? That's, of course, the key question. But I think it's undeniable that going forwards, if we're looking out 5 to 10 years, it is really undeniable that, of course, technology will still play a huge part in everyday life. But again, I would add to that, I would not expect to see the sharp levels of growth that we have sort of experienced, obviously, this year.
Yes.
Again, we could tie that again back to the importance of a well-diversified portfolio.
Yeah.
Interesting themes, though, aside from the kind of obvious in the technology one, I would say a couple really are emerging. So one that I think we touched on maybe a couple of videos ago that we're still seeing play out even stronger now is businesses reassessing, reevaluating their supply chains.
Yeah.
They are diversifying their supply chains away from core countries. So traditionally, they may have sourced a lot of their produce from China, but now they might be looking to diversify across emerging markets for their supply chain. And what that's doing is creating fantastic opportunities for other countries in emerging markets to benefit from businesses reassessing those supply chains. So we're actually seeing a more diverse opportunity set across the emerging market region. So we do quite like that theme. We're playing that theme in all of the portfolios. And the other theme that we're playing in the portfolios as well is the transition to renewable energy, to a sort of more greener future. This is a much longer term play, obviously, but again, it's an undeniable trend across the world, really, that we need to upgrade our infrastructure globally to cope with the shift towards renewable energy or cleaner energy. And again, we play that theme throughout the portfolios. So something that we expect to see added investment. And again, it's a great area of investment because it really doesn't get that impacted by the macro. So for example, the importance of shifting to more renewable energy is not impacted by who wins the presidential election, for example. Countries have emissions targets to meet, and they need to meet them regardless of the macro. So we quite like those in our alternative space to help diversify the portfolio and see new opportunities looking into the future.
Yeah, because I know you say what's happened in the US, and we'll touch on that in a moment, won't have much of an impact, but actually I think Biden's already said he'll sign back up to the is it the Paris Agreement or the Tokyo Agreement? I lose track of how many agreements they've had, and also Trump was very much the sort of redneck American, we're going back to coal, we're going to protect this. But actually, it was quite interesting. I read an article last week where in Central America or Central US America, they're saying actually they're still closing the coal fires down. They're still coming away, even with Trump trying desperately to play to that base. And of course, we still don't know if he's going to leave the White House on the 20th of January voluntary, or if he's going to be arrested, but that's a different story. And just to clarify, in terms of the emerging markets, so clients understand, there we're talking, I think still talking about the Far East, but we're now starting to talk about places like Vietnam, Thailand, the Koreas. I don't know whether North will open, but we're talking really, we're expanding more into and Malaysia, and obviously places like Singapore where Dyson have moved to. So that's where we're seeing that growth, and you anticipate that will continue, even though COVID potentially is still an issue over there because of the sheer volume of population.
Yeah, that's right. And interestingly, a lot of the nations over there have demonstrated the ability to bounce back faster from sort of the COVID pandemic. And again, that stems to multiple factors, one of which being sort of the social side of things, adherence to government guidelines and the wearing of face masks and things are much more socially normal, sort of socially kind of more traditional, if you like, in certain regions. And that's massively helped those countries re-emerge from the sort of early stages of the pandemic. So yes, we do see a wider opportunity set across many more different countries in the region. And that's what we are quite interested in at the moment.
Okay, well, the political argument about people doing as they're told could be quite interesting, and I'm going to avoid that very, very quickly, but I'm going to dive in with Brexit, because obviously that is now around the corner. We're, 3-4 weeks away from officially leaving the transition period. There's still not an agreement on the table, but from the noises I'm picking up, they're going to do it probably on the 29th of December or something silly like that. Do you see Brexit as a big issue, or again, have we played that into the market, and actually having an agreement is the only thing that will see the markets move up or down, because everyone goes, thank God they finally done it?
Yeah, that's I've lost track of the amount of times I've heard it's been a crunch week for Brexit negotiations. I mean, every week seems to be a crunch week. So, and as you say, we still don't have anything concrete. Very important for obviously yourselves and your clients to know that we haven't taken a speculative bet on whether we think we will or won't get a deal. We have not positioned the portfolios and tried to base that on an outcome that we think may or may not happen. So we absolutely have not done that. We do not take that risk in the portfolio. We actually have some of the lowest exposure to UK assets that we've ever had. And again, that stems back to, we find equally interesting opportunities, as I touched on, emerging markets, Europe, in Japan, in US. So we do have a UK exposure, but it's at the lowest it's ever been. We have to think about, obviously, a deal, I think, would be positive. I think you would get a relief in equity prices. Certain sectors or certain areas of the markets would do better than others. And the other thing we need to consider is the currency. So the strengthening of sterling, which we can probably expect to see, depending on the kind of strength of the deal, that may have a negative impact on some UK assets. So we could see that some UK assets under what would be perceived as a good deal could struggle. Others will do better. I think broadly, there would be an improvement in sentiment, but again, we don't really want to take that risk in the portfolio. The exposure that we do have would benefit from that, but equally, so would our European assets. A lot of our European assets, we also expect to see a positive move on the back of what would be considered a sort of a positive deal. So yeah, we haven't positioned them to benefit from a deal or a no deal, if you want to call it that.
Yeah, I think that ties in with a lot of conversations I'm having elsewhere, where people have gone, actually, Brexit hasn't been an issue for the markets for about 6 months, because we know it's happened, we know what's going to happen. One way or the other, a deal will be done, whether it's with the WTO agreement or whether it's a bespoke agreement. And a lot have said, actually, globally, it means very little. It's just big news for the UK because it's big news in the UK. It sounds a bit dismissive, but I think that's probably the way of looking at it.
Yeah, I think, and again, global markets, by and large, now do look at it a bit like that. So, obviously, it's very important for us here, and it's on news a lot. But I think, you're right. Across the world, we may see reactions slightly less muted.
Yeah, it's the old adage of we think it's important. Everyone else just goes, oh, there's a little squabble going on over there. They'll sort it out. And talking about squabbles, the US, we obviously had Biden officially or unofficially confirmed as the president-elect. Again, Donald Trump making interesting comments, and now the Republicans seem to be fighting back against him. Do we think, because obviously the US is struggling with COVID, even though the FTSE is now at an all-time high, predominantly, I believe, because a decision was made by the electorate one way or the other, rather than anything Donald Trump did, despite what Donald Trump says. Are we still seeing the US as the engine that drives the world economy? Or because of what you said about the emerging markets, because of China, because of the size, and because America is sort of behind in terms of moving forward to green energy and new technology now compared to others because of what Trump has done over the last 4 years? Does it matter? Will Biden make any difference to what happens in the US and how people view the US as an investment area? And B, how are we moving away from that? The US caught a cold, the US had a sneeze. The rest of the world catches a cold, which is what I grew up with in this industry for the last 20 odd years.
Yeah, it's funny. I mean, and November was certainly an action-packed month for markets. Obviously, you had the vaccine announcement, and then closely, obviously, the presidential election result. And I have to say, the presidential election result was basically the best outcome that markets could have ever hoped for. So effectively, the election of Biden removes a sizable amount of uncertainty, and it's widely expected it will result in an easing of trade wars and an environment that will boost global growth and corporate earnings. So the market, first of all, reacted fairly favorably to that. But almost more importantly was the Senate still looking like it will be Republican controlled, which effectively what that means is the pro-business policies, the tax cuts, the deregulation that Trump introduced should stay in place. So it really was the best outcome that markets could have hoped for. And we absolutely saw that in the reaction to markets. And of course, it came at the same time of the vaccine announcements as well. So everything did get rather excited. The other point to note as well that the market really is paying attention to, and that we're certainly latching on to, is the sort of less likely, it's less likely that we will going forward see market disrupting tweets, shall we say, that Mr. Trump was very renowned for. So again, under Biden, we do expect to see less of that. And of course, the markets are digesting that, say, okay, we've got more predictability, should we say, maybe more stability. We don't expect to be, waking up one morning and seeing a sort of a tweet that will send areas of the market sort of either soaring or plunging. So broadly, very positive. Yes, the US economy is still extremely important. We do see it as one of the sort of key drivers of global growth, of course, and the kind of the election result. And as I say, the Senate, the way it looks like the Senate control is going, really is the sort of perfect cocktail for the markets in the current situation. And again, we've seen that played out in the markets. And again, all the portfolios have good exposure to those assets. It really did boost the performance through November.
Yeah, I think the only thing we've got to worry about, and I will email you or text you if there's a Twitter first thing in the morning from Biden that we don't expect, just to remind you of what you said there. But I suppose the biggest risk for the next 4 years is, does Trump win again? And does that split America even further? And Biden, just because of his age and health, what would that happen? But I think in Kamala Harris, there's quite a nice steady pair of hands, and actually she appeals to both Republican and Democrats, and pretty much across the full range of US population. So in a way, even if something happens to Biden, I think hopefully 4 years of relative calm, even if we have the first black female US president.
Yeah, I think that's right. It comes back certainly back to that removal of the uncertainty, really, that sizable uncertainty, that perceived stability that the election
Yeah,
result brings. And again, that's exactly what the markets need right now more than ever,
yeah,
especially if you consider what's going on with the macro and the sort of pandemic as
yeah.
well. Absolutely what the market needs. That's been reflected in asset prices. And again, we're very well positioned in the portfolios and have benefited from that through November. Absolutely.
Absolutely. Well, Alex, thank you very much for your time again. Obviously, it's the last time we're going to talk before 2020 finally plays out. So hopefully a nice relaxed Christmas and New Year, not meeting with too many people and still touching elbows from a distance for yourself. And then we'll pick up and see what the first 3 months of 2021 bring, which hopefully will be continued good news on the vaccine and whatever normality was coming back to us.
I very much hope so, yeah.
Alex, thank you very much for your time for now and over 2020, particularly at the start of the pandemic. Very much appreciated. Look forward to talking to you next year. But for now, from my point, wish you a Merry Christmas, Happy New Year, and I'll speak to you soon.
Thanks, Tom. All the best. Speak to you soon.
Take care.
Cheers.